Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment at the market site in Times Square, we have Phil Mackintosh, chief economist at Nasdaq, to discuss if this correction we're seeing in the market is actually healthy in stocks. Phil, it's great to see you as always, and let's review our week. But coming into trade today, we're off a couple more percentage points here.
Yeah, I mean, it feels a little worse than the last week has been. I mean, obviously the markets are down a lot this year, and each day we seem to have really big moves, but actually we've had some decent up moves as well. So the last 5 days, even including what's happening right now, the markets are kind of sideways in stocks. And actually in the bond space, we saw interest rates get up on the 10-year to 3.2%, then they came back down to 2.8, and they've sort of drifted up over the same time back to 3. So both are kind of forming in a range at the moment.
And both are kind of moving at pretty interesting velocity as well. It's not typical, especially on the rate side, to see those kinds of moves. The data, though, shows the economy remains strong, however.
Yeah, the data this week for sure. If you look at retail sales, it came in even stronger than before. After inflation, even, the retail sales are actually picking up. So one of the really interesting things is people are spending much more on things, but they're not actually buying that much more because the difference is inflation. You're spending a lot more to buy the same amount of stuff. So from a company's perspective, you're starting to see them with same sales, even though prices are going up. But you look at the amount of savings that people have still got in the system, except for the bottom quartile of earners, everyone still has a lot of stimulus savings to spend.
In the fourth quarter of 2021, we were seeing markets at all-time highs. I kept hearing these valuations are not sustainable. It's because the Fed is propping up the market. Is the sell-off healthy for the market and stocks at the end of the day then?
Yeah, I mean, I think it is healthy. I guess those people have been proven right. But in reality, what we're seeing is interest rates have gone up a whole lot since the end of last year too. The 10-year's gone up over 1%, the 2-year's gone up even more. And so what we're seeing is the market repricing for this new interest rate environment. So you think about how stocks are valued, you look at all of the earnings they're going to make, and if interest rates go up, they're not going to make as much. You've got alternatives in bonds, and so they have to outperform more to be the same value. So basically what happens is the stocks with exposure to interest rates and a lot of growth on earnings are going to fall just to account for the interest rates changing.
So then it sounds like it's even more healthy for value stocks.
Yeah, so if you actually look at the performance, the value stocks have performed relatively well. It's only the last few weeks they've started to fall a little bit, whereas the growth stocks have taken most of the pain. And that's because their earnings are in the future. That's the whole point. They're going to grow. And so when interest is almost free or money is almost free, those earnings are really valuable 10 years from now. But as interest rates go up, the 10-year forward earnings aren't worth as much as today's earnings. And so it makes a lot of sense. If you look at the distribution of company performance, it's actually pretty rational. So the companies with the strongest PEs or price to earnings ratios with the more growth have actually underperformed the most, and some companies are up. A lot of the energy sector has actually outperformed. The whole sector is up 40% year to date.
Yeah, and you have pointed out, as well as a number of economists and strategists, that longer term, however, these sell-offs are historically followed by positive markets.
Yeah, and we looked at what happens in rate hike environments, and it's pretty common to have a 15% odd sell-off as interest rates start to go up, just as everybody does what we just talked about, re-rate the valuations, rethink everything. So where we are now, historically, pretty normal looking sell-off, quite a lot of volatility, but it's possible statistically that 12 months from now the markets are actually stable or back up.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.